Happy Wednesday. I am Bryan, the Chief Investment Officer and President of Bryan Financial Group, the home of AfroEconomics, and it is Wednesday night, the night I love to make sure that we talk about financial empowerment. Make sure you tell all your friends to go to AfroEconomics.com, get registered so that they can subscribe, like right above the fro, right here, and then they can actually get the invites on their own. And they won't have to depend on you to tell them about all of the events. And also, a member brought up to me this morning that there are people on government furlough that actually, now they're not members of AfroEconomics, thank God. They actually are doing GoFundMes, because if they were in AfroEconomics, they would have their emergency fund. So anybody that's out on furlough now that does not have their emergency fund together, I promise you, you will be back to work. And let's get to working on your financial house and getting your financial house in order. I don't ever want to ever see anybody that I don't know, or especially not that I know, doing a GoFundMe because they're on furlough from the government. That job is way too good, for you to have not been putting away an emergency fund for yourself. We definitely have to get that together. And it's hard for me to feel sorry for you, or any of your family members to feel sorry for you, when they know how long you've been working there and that you're in a position like most others aren't, to know exactly what you're going to get paid. And all you have to do is make a decision to put at least 20% of that away. That's the way I want you to feel it. It's 2019. I want us to embrace the fact that we have to learn to live within and below our means. The more you focus on your balance sheet, your wealth, and the less we think about how we look to other people, the wealthier you will be. No, the majority of wealthy people, overwhelming majority of wealthy people that I know could absolutely care less of what anybody else thinks about their financial decision to keep that car and have that paid for car, and to buy cars and not finance cars, and to have the title on their stuff. They could care less that there's a new one that came out and their friends are going to get it and set up that payment plan. No, they don't care about that kind of stuff. So we're talking about interest rates and how interest rates impact your investments. Now we've got a whole bunch of complicated stuff on interest rates and how they, I want to share something with you on the screen, but I want to focus on what really is going to help you and your wallet. But I want to show you, just for the sake of making sure that you know that we know, okay? So this shows interest rate hikes and bond returns from 1958 to 2007. And it just shows how, when the interest rates at the start of 2003, interest rates at the start of 2003 were less than 1%. At July of 2007, so that's 4 years later, interest rates were at 5.26. And corporate bond returns for that time period were 17.8. So as these interest rates grew higher, the corporate bond returns grew higher as well. But if interest rates come higher, are boosted higher, and you have these bonds that you already have in your portfolio, the new bonds coming out at the higher rates bring down the value of what you have in your purse. It's like you live in a neighborhood and they start building new homes in your neighborhood. So this is like when new things come out that pay a better payment, then you have the challenge of holding something that doesn't have as much value because the payment that you've been promised on your existing bonds that you have is not as attractive. Like having the house that got built 2 years ago and they're building new homes in the neighborhood, right? Well, these new ones have more value because of the payment that they're promising to pay out is higher. So it brings down the value in the bonds that are already existing in your portfolio. So there's a lot of people who think that if you have bonds, then they don't go down in value. And that's not true. Bonds have volatility as well. It's not just stocks that have volatility. You also have like with you could have a CD, a CD that is paying a particular interest rate. Hi, everybody that's calling in on the call-in listeners. How are you? Yes, indeed. Sorry, you can't see me, but we can feel your presence. That definitely when we're talking about the impact of bonds on your investments. So theoretically, in theory, you have this, say you have a CD and the CD is paying 2%. And the Federal Reserve comes out and they said they're increasing the Fed funds rate. That's the borrowing rate that banks borrow money from each other. So that's the base rate for the entire country has been increased. So this CD, now the Fed funds rate, let's just say now they say they increased it to 3.5%. So all of a sudden you have this 2% CD and you get no advantage for that. There's nothing good that you can do with a CD that is paying only 2% when the new ones are paying 3.5%. So the value of your 2% one has gone down, but because it's not really a traded investment, it's not traded. Like the bank itself loves that you have this 2% one and you have to hold it for say another 3 years because the new ones, they have to pay out 3.5%. So they give you that penalty if you try to get out of that 2% one. But if that was a bond that was at 2% and the new bonds were coming out at 3.5%, a publicly traded bond, well, you can actually sell off your 2% bond, but you would have to sell that still at a discount because what? It's not as attractive. Everybody wants the new 3.5 ones. But just say if it was opposite, the Federal Reserve said, I'm going to lower interest rates, and you have this bond that's paying 3.5, they've lowered the Fed fund rate, say, to 1.5%. All of a sudden, everybody wants your 3.5% bond. You're looking good, right? So it can work for you as well. So we've had time periods. I want to try to pull up a graphic that I thought was interesting. I'd be like, that ain't really that interesting. He's like, you think it's interesting, but this particular one I shows interest rates and stock returns over the last 10 years. So I'm gonna come back and get y'all, and I'm gonna share this screen because I'm all of that. I know how to do it now. Do it now. So the interest rates and equity returns over the last decade. When the financial crisis hit, I think this is Federal Reserve Bank of St. Louis is the source of this. So when the financial crisis hit, stock returns were hit as well. The S&P 500 fell 37.2% in 2008, but the Fed slashed interest rates. The index rebounded and was up more than 88% between 2008 and 2017. Oh my goodness, look down on the bottom. Let me get my little pointer. Let's see. So look down here. These are the years down here on the bottom. And this blue is the Fed fund, the interest rates. And in the green, this is the stock market. I'm messing all up with red. But look how Fed funds, they were decreasing their interest rates here in 2010, or they put it up slightly. Look at, goodness, look at where it was. 2008, the Fed funds rate was at 3.94. All hell was breaking loose. And look at that. Shoo, they brought that down within a year to 0.15. My goodness, look at people that were depending on getting 3.9. They were getting like probably 4%. Like, not even probably. I've been in this business since 95. So like my graph gotta be way out here. So, but 2008, it just seemed like, oh my goodness, it was just so much going on in the market. And then, so we're losing, you see here, the S&P 500 almost cut in half from 100 to 62. 62.3, they're bringing down the rates. And they would never admit that they were trying to help the market out. They brought it down, they said, wow, it still didn't work. So look, they brought it down some more, 0.11. The market started coming up. They like, whoa, I'm not gonna mess with it. The market starts coming up, thank God it's so low. And here we are now, easing our way back up. Goodness, but as I shared in their invitation for tonight, that the brother out of Atlanta is head of the Atlanta Federal Reserve Bank. He was saying that he doesn't suggest that that they do an interest rate hike, for next year, or if so, only one or something like that. But, definitely he can do that now because he doesn't vote next year. And that's something. So what he said is just saying it, but his vote doesn't count. So it's that's probably the only reason that he can say what his opinion is. They'll probably let him say his opinion because his opinion really doesn't matter. But with the market, with what we had last quarter, and it's not really supposed to be connected, but the economy is doing well. They do this increase to try to make sure that they slow down the economy to avoid us getting into high inflationary times. But to control inflation, because when they increase rates, they're slowing down the money supply, so people don't take out loans as much. When they reduce interest rates, they're increasing the money supply theoretically to help people finance things more easily, to encourage industry growth and things like that. So there's a method to the madness. But definitely I want to get out because I want to see you again. Here we go. But definitely interest rates can have an impact on more than their attempt to hold down inflation and help industry by lowering the interest rates. They're not supposed to really be connected to the economy on that level, but how can they not be? How can they not be? You saw that by that graph. They saw the market go crazy. What did they do? Start helping it. They lowered the interest rates, increased the money supply to help businesses finance their growth so they can hire more people and help us have that 10-year run. It's real. So what you need to keep in mind, though, when it comes to interest rates, the most important thing for us is increasing in interest rates makes it more, and we're in that time. If a person is on the edge trying to get approved for some sort of debt, and their credit score is okay, but their debt ratio, is already weak, and their payment has to stay at a certain place because they got the car payment, they got the school loans, they got these credit card bills, they're trying to get approved for this house, and they said the house payment can be at six, right? $1,650. So it has to be $1,600 or below. And they're trying to get this house that they like. Well, interest rates pop, and the lenders, just if you have a 1/4 point adjustment with the Federal Reserve, that doesn't, that doesn't like stop. That doesn't mean that the mortgage company is only going to do a 1/4 point interest rate increase, because the mortgage company has the challenge of what? Locking in a rate that they have to keep forever for 30 years. So they have to figure out, they have to adjust it enough so that they can still make money, forever. So a 1/4 point increase might mean a whole point increase on your mortgage loan, especially depending on the credit score and how much you're trying to borrow and what percentage of the value you're trying to borrow. Because if you're only trying to borrow 80%, you have 20% to put down, they can give you a better interest rate because they have equity in there. Their risk is lower. Think about this. This is real, y'all. This is real. Everything is connected. So as we continue to think about interest rates and how they impact us, we must think about how we can use interest rates to our advantage. How do you use interest rates to your advantage? Only if you're in a situation to actually own something. Right? You have to have something. So if you have something that you are going to finance for someone else, or someone else who's going to rent a property from you, and you're going to do a reasonable interest rate amount of increase in that payment each year. But you would be amazed at how many people don't do that. They have rental properties and people have been paying the same exact payment for 5, 10, 20 years. I have this one client, the only way she got out from under a seriously bad situation was she had to actually sell the property because she had allowed the person to live in her property for so long, so cheap. So when you're trying to sell it, you would want to have an attractive interest rate. So you would want interest rates to be low when you're the seller because you want them to be able to finance it. But isn't it great when you can have your own money and not have to finance it? When you can actually be the lender, when you have the money, somebody needs to lend it from you, you creating your own interest rates. You creating a situation to be the lender. You creating a way where a person is renting from you, but they're also trying to purchase it, or you can even do owner financing and make money off higher interest rates and benefit from higher interest rates. When you're investing and you don't want to take on a lot of risk, interest rates, higher interest rates will help you, especially when you're a fixed interest rate investor. Because of the environment that we've been in, as you saw in that graph, 0.13, 0.15, 0.18. I mean, really? So if you're a very conservative investor and you're looking for fixed interest rates, you're sacrificing a lot of return because you don't want to take on the risk of that equity market that you saw take that big dive. So, there's definitely reason for us to make sure that we include in our discussion the impact, but a lot of what actually happens with interest rates, really guarantee, you can't guarantee that, oh, interest rate drop is going to make sure that the stock market is definitely going to love it. No, sometimes there's interest rate drops, you can see historically, where not all the time that the stock market is going to respond in the most positive ways. Or it might not, the Fed might not increase the interest rates as much as anticipated, but because the market has already anticipated a 0.5% increase, even if they increase it only a quarter, the market could still fall, because even though it was great news, because the market had anticipated was, kind of overjumped the gun. And then, so what happens when interest rates fall? When the economy is slowing, the Federal Reserve cuts the federal funds rate. That's the interest rate that we're referring to. It's formally called the federal funds rate, to stimulate the financial economy. A decrease in interest rates by the Fed has an opposite effect of a rate hike. Investors and economists alike view lower interest rates as catalysts for growth, as I was sharing. And then I just want to give you a little bit of the textbook version. A benefit to personal and corporate borrowing, which in turn leads to greater profits and robust economy. Not guaranteed, but that's what we want, the lower interest rates to help with corporate profits and to increase the economy. So in hopes that consumers will spend more with the lower interest rates, making you feel that you can finally afford to buy that new house, send the kids to a private school. Businesses will enjoy the ability to finance operations, buy other businesses and expansions at a cheaper interest rate, thereby increasing their future earnings potential, which in turn leads to higher prices. Now that would be totally like what we would say if that was a textbook question in business school. What would you anticipate with when interest rates fall? And then we say, oh, the economy with this, but that's just in a perfect textbook world. But we need to have that understanding of that. Oh, how you doing, Natasha? Miss Ruth Robinson, Jimmy Coates, yes indeed, thank you so much. Oh, Pastor Etheridge, Mr. Booker, how are you all doing? It's so good. Oh, we have a huge group in the webinar tonight. I'm just amazed. Like, y'all are geeks. Y'all are as geeky as I am, participating and loving a workshop on interest rates in your. Make sure you ask me questions so that we don't finish with me just telling you what I want you to know. How you doing, Miss Dickens? Hi, Craig. Hi, Demetrius. Hi, Miss Walton. Hi, Kay. And Kathy, you are the woman. Yes, indeed. Lawanda. Hi, Maurice. You saw, how about them Cowboys? Woo! Yes. How are you, Pamela? How are you, Ronald? How you doing, Roy? Good to see y'all. I was on the Carl Nelson show today, a radio show out of DC. Yes, indeed. 1450. You gotta look him up. Yes, indeed. I've been in DC since 1997. I started the firm in 1995. I love me some Nation's Capital. Let's sum it up. We only have a few minutes left before y'all leave me. Some key talking points. That the bottom line in the relationship between interest rates and the stock market is, fairly, we can't say direct, but it's indirect and it is connected. The two tend to move in opposite directions. As a general rule of thumb, when the Federal Reserve cuts their interest rates, it generally causes the stock market to go up. When the Fed increases interest rates, it generally causes the stock market to go down. But there's no guarantee how the market will react to any given interest rate change. So the key, I feel, as I address selecting investment portfolios for you and establishing the AfroEconomics investment portfolios, I feel that the key is to just make sure that I am in tune with your specific risk tolerance. And then also making sure that you know that even if you have a portfolio full of all bonds, remember, bonds can be volatile in relation to interest rates as well. And so it's important to have a well-diversified asset allocation portfolio. See, I can't just say diversification, because you can be diversified, but that diversification could mean that we have all stocks. So then you're just diversified into one asset class. But asset allocation is a whole, is like diversification on steroids. It takes us to another level. Then I am investing you across asset classes. So I have to know your risk tolerance, and I want to make sure that your risk tolerance helps me make sure we set up the appropriate asset allocation, and that I continue to empower you as a member of AfroEconomics. Make sure you take advantage of AfroEconomics. In 2018, on Thanksgiving Day, I established the free, no excuses AfroEconomics membership. And it hasn't done a thing to stop those of you who have signed up for the comprehensive plan. So once you get in as no excuses, all that it does is allow you to level up. Once you're ready to sit down and do this portfolio stuff and look at your investments at work and stuff like that, you'll be ready. So, take advantage of whatever God has allowed me to share with you. Take advantage of the No Excuses membership at AfroEconomics.com. Also the individual membership, the family membership, the Gianyame, which is scripture-based financial management, and the entrepreneurship membership, my favorite, because I started my business without having anybody like me to help me. And I want to empower entrepreneurs. That is a key footprint I want to leave on the planet. You heard some of the interview. I'm glad, Maurice. That's all good. I hope your interview went well last week. I hope you didn't interview with the federal government. You might not hear back anytime soon, bud. But that's all right. They are going to call. You all will be back. And I know, and I'm sorry that you all are going through that, but this too shall pass. And remember, I have been waking up every day, getting after it, feeling like you feel every day, but what helps is make sure you're making progressive moves towards your dream. There are people everywhere making money both ways, because, eventually they're going to have to pay you. You're going to be all right. So make some money in some other ways right now. You can look at the videos, get empowered, do everything you've ever wanted to do, because time is money. Check out the video from last week when we did time management and your wealth. It's real. 1,440 minutes in a day. Maximize them. Thank you all for sharing with investments and your interest rates and your investments. It was fun. I hope you had as much fun as I did. Don't forget to get the book, AfroEconomics, Our Black Wealth Matters, and the free workshops in DC this month. DC, Saturday, the 26th, and then next in February, I'm in New York, and in March, I'm in Virginia, and then we're having AfroEconomics Equality Weekend. You see the King Brunch right there. We're having the college prep day. So, oh my goodness, January is an exciting month. Please check out, and most of this is absolutely free. Check out the King Day Brunch. If you are not a member, then you have to pay for the King Day Brunch. But we have free membership. So why would someone pay? But don't tell them. Don't tell them. I'll tell them. But sign up for membership, come out to the King Day Brunch. Make sure on Sundays that you do you participate in the soul of your money. It's growing. I'm growing. I'm learning and enhancing my relationship with God. I hope it can do the same for you. Be empowered. I love you all. Thank you. Thank you for everything. Continue to believe. Talk to you soon. The interview went well. Uh-oh, I love it. Be more, watch out. God bless you.